Elevance Health stock is down over 10% today after reporting earnings and slashing their guidance. And in the past year, they're down over 40% as a result of the healthcare industry seeing higher costs and just overall trouble in that industry. And for this second quarter of earnings, Elevance Health actually reported a beat on their revenue, which they reported $49.4 billion of revenue, which is up over 14% from the same quarter in 2024, in which it exceeded analyst expectations of $48.2 billion of revenue. However, if we take a look at the earnings per share, they were expected to actually have $8.92 of earnings per share, but they actually came up a little bit short on $8.84 per share. So they did beat on the revenue. However, they did miss on the earnings per share as a result of higher costs in the medical industry. However, the biggest news that came out of this report was the expected earnings per share for this year, in which they reduced this by a lot, in which they slashed their guidance from previous quarters, in which they expect their earnings per share for this year to be at about $30, in which previously they thought it to be $34.15 to about $34.85. And with this being said, with this huge drop in stock price in Elevance, I'm going to be taking a look at the financial health of the company, and then later in the video, I'm going to be using my intrinsic value calculator in order to determine the price I'd be willing to pay for the stock. The first two metrics that I always like to look at is the valuation metrics, in which I like to look at the trailing PE ratio and the forward PE ratio, which is just the price divided by the earnings per share, in which the trailing PE ratio is the earnings per share from the past 12 months, while the forward PE ratio is expectations by analysts for the next 12 months. So the trailing PE ratio takes a look at the valuation in the past, and the forward PE ratio takes a look at the valuation in the future. And I want the trailing PE ratio just to be positive. If it's positive, that means that this company is making money. So that's all I want from the trailing PE ratio. And as we can see here, it is positive at a 13.23, which is actually pretty low, especially compared to the stock market, which trades at about a 25 PE ratio as of right now. So this is at a pretty undervaluation when compared to the market. And looking at the forward PE ratio, I want this less than 30, showing that it's trading at a decent valuation, in which the forward PE ratio is at 989, which means it's actually at a very low price. And if you bought the stock today, that means you're going to be paying $9.89 for $1 of future earnings in the future. So this is a very low valuation, but it does make sense just because of the industry it's in and the struggles it's been having. Now I'd like to take a look at the revenue growth rate of Elevance, and I want to see this growing at a greater than 5% rate. And as we can see here, they've been growing at a very decent rate over the past few years, and they've really accelerated this at a pretty good rate, and they've been growing at about double digits for the past 5 years. So this looks pretty good, and I'm pretty sure they're growing at about a 12% rate each year. So I want this greater than 5%. Clearly, it's growing at a good rate, greater than 5%. So this looks good for the sales of the company. Now, taking a look at the net income, which is the amount of profit that this company generates, and I want to see this growing at a greater than 5%, similar to the revenue growth rate. However, as we can see here, it's actually been growing at a slower pace over the past 5 years. It's actually been pretty stagnant, which I think is because of the higher medical costs in this industry, resulting in lower profit margins. Even though the revenue is going up in this time, the net income has stayed pretty steady just because of the profit margins decreasing. So this doesn't look as good compared to the revenue growth rate, but nonetheless, it's still growing at about a 5% rate. So it's right in line with what we like, but I still don't really like this lower net profit margins each year. The next metric that I like to look at is the shares outstanding, and I want this to be decreasing over time or them buying back, which is the same thing. And the reason I want them to be buying back shares is because as there's less shares outstanding, that means we'll own a greater percentage of the company and we'll actually receive more earnings per share, which is why when the buybacks happen, the earnings per share will increase even if their earnings do not increase. So this gives us more returns as investors. And as we can see here, they are buying back at a pretty decent rate at about 2% each year. So this looks pretty good for Elevance, and they're buying back shares at a decent rate. So I like that about Elevance. It's returning some better profits for the investor in the stock price. The next thing that I like to look at is the balance sheet of a company. Similar to us as individuals, we don't want to have a lot of debt compared to our equity or anything else because we don't want to go bankrupt. And as we can see here, we want a total debt to equity ratio less than 50%. If it's less than 50%, that means that the company has less than half the amount of debt compared to their equity. So right here, it has a 70.4% total debt to equity ratio, which is a little bit high, but it's not terrible. But nonetheless, it's still an X because they have more than half the amount of debt when compared to equity. But if we take a look at the total cash and total debt, they actually have more cash than their debt. So their net debt is actually negative. So this looks good for the company because they could just pay off all their debt right now if they really wanted to with all this cash. So this is actually a pretty good balance sheet for Elevance, which I'm actually surprised at. Now, the final thing that I like to look at is analyst expectations for the next 5 years. And I want the earnings per share growth rate to be greater than 5%, showing that in the future, we're going to be getting a decent return on our investment and seeing the company actually grow over time. And as we can see here, over the next 5 years, they're expected to grow at about 11.4% rate each year, which is actually very fast. And I don't know if that's actually going to happen. But the company did reiterate in their earnings report that they're going to still try and confirm that they're going to grow at 13% each year, which if they can do that at this valuation, this is definitely a steal of a price. But do I think that this is going to happen? Probably not this fast of growth, but I still think they're going to grow at a decent rate. And with that being said, I'm going to be taking a look at my intrinsic value calculator in order to determine the price I'd be willing to pay for Elevance and to see if we should be buying today after this big drop in stock price. So the first thing I have to look at is the future annual revenue growth rate. And over the past 10 years, they've actually been growing it at about a 10 to 12% rate very consistently. And analysts expect them to grow at about 11% earnings per share. While I do think that that is a little bit high, I do think that they could probably grow at about 7% to be conservative. Because of the huge issues coming up with healthcare companies, I'm going to be slightly conservative here. Now with the future profit margin in the next 10 years, I have to predict what I think it's going to be. And the profit margin for Elevance has actually been slowly decreasing basically every year, which is a pretty big red flag to me, and I don't like that about this company. But nonetheless, right now they're at about a 3.5% profit margin, and they've been anywhere from 2.5% to about 5% over the past few years. So I'm thinking a fair net profit margin in the future is about 3%. And the reason for that is just because I think that in the future they could stay right about where they are today, and I don't think they're going to decrease that much. And in the future, hopefully they can settle down on these medical costs, and hopefully they can stay at this net profit margin. Now for the future PE ratio. Elevance is definitely a below average financial health company compared to the stock market just because it's not growing as fast as the stock market in terms of their growth rate. And also the future profit margins are very low. So with the PE ratio, it's definitely going to be less than 25 since 25 is the market average. And right now they're trading at about a 12 PE ratio. So I think a fair PE ratio is actually 15. Now going to the shares outstanding. Each year we saw they're buying back shares at about 2% each year. And I don't think that's going to change because of the buyback programs they have in place. So I think they're going to be buying back at 2% each year. And with that being said, I get a future share price in 10 years at $879 per share. And the current price is at about $300 with this recent drop, showing us a total annualized return each year of about 19% if you bought this today. I would say these are looking like very good value prices for most of these health insurance companies like Elevance and United Health. However, me personally, I am not buying yet just because of the huge uncertainty in the future and the worries over these medical costs and all these investigations into these companies. Me personally, I'm not buying today. I'd like to see this get down a little bit further to ensure a greater margin of safety. But if you do believe in this company, right now, I think you can make a very good return of about 19%, in which we aim for about 15%. But nonetheless, I'm still worried about this company in the future. And I don't really understand health insurance that much to the point I don't know if I'd even be buying any of these companies unless it got to an insane value. But thank you guys for watching this video on Elevance Health. Please subscribe, hit the like button, comment down below what companies you want me to analyze next, and thank you for watching.